So that's the general idea. At the end of the year, we have those adjusting entries, which is where the journal entries are going to be most useful typically, because the adjusting entries are typically designed to put us more on more on an accrual-based system or possibly a tax-based system, so that we have the financial statements as closely aligned to the proper timing according to whatever we're doing, taxes or external reporting. And so usually there's timing differences that are involved there. So we'll talk about those in a future course or section, but you can go through some of these, like accounts receivable. You might have entered an invoice after the cutoff date when you did the work before the cutoff date, in which case you can imagine that you might have to bring the revenue into the current time frame. There's a timing difference possibly. So we could have a similar kind of thing for what else might we? The loan payable. We might use an adjusting entry to break out the short-term and long-term portion of the loan payable and possibly record the proper interest according to the amortization schedules. If you had payroll, payroll is usually going to be on its own cycle, because you might pay people bi-weekly, semi-monthly, weekly, or monthly, which might not line up exactly, meaning the end of the pay period might not end at the end of the year. So you might have some liabilities that should be properly recorded, but so you might have to do an adjusting entry like for payroll, unearned revenue, and so on. Now, when we do those adjusting entries, all of those adjusting entries are typically going to be done as of the cutoff date. For example, the end of the year, December 31st, 2025 in this case, right? If they were all done at the end of the year, then we can identify those adjusting entries by the fact that they were all entered as of the same time, and by the fact that they're going to be journal entries rather than forms, right? And so that means that if I go to this first tab, if I go to my reports over here, we have a form called a journal entry, or a journal form. Here's a journal form. And so this will give us all the transactions by journal entry. And let's do this for custom date range. Let's go from 01/01/25 to 12/31/25. Run it. All right. So here we have all the transactions. Now, if you want to learn the journal entries, this is actually a pretty good form to look at, because you'll be able to see the debit and credit format rather than a running balance of increases and decreases as we see on the balance sheet. In other words, on the balance sheet, if you go into the checking detail, this is a type of form that from a textbook would be like a general ledger type form, but they call it a transaction report. But instead of recording increases and decreases with debits and credits, they just show them as increases and decreases, as you might do from an accounting equation standpoint. Assets equal liabilities plus equity, the assets going up or down. If you look at a journal form, then it's gonna break out the transactions that have been put in place and break it out in debits and credits, so you can kind of see it in debits and credit format there. All right, so you can see down here we have our transaction we entered for the 10,000. Notice that it's in there with a journal entry. We see these other forms that are not journal entry forms. And if I wanted to filter, then I can filter by transaction type, which is one of the most common filters. So I can then go to the filter option up top. And so we want to filter by transaction type. And then I'm going to make it a journal entry. So they do that funny naming conventions, a little bit different. They call it, and then it didn't show it. Where is it? Refresh. There it is. So I hit this refresh button. So there's our one journal entry form. So that's how you can kind of see the period end adjusting entries, because they'll be in there as of one date, and they'll have all of them in a journal form rather than in other formats. Let's go to the prior year just so we can see the prior year. Let's go to custom dates, go from 01/01/24 to 12/31/25. And so these are just the journals that were entered. Let's take the filter off, removing the filter, and let's just go boom and clear the filter. Okay, so now we can look at the deposits. So you can see here, this was with a deposit form, and we could see from debits and credits, we had an increase with a debit to the deposit to the checking account, and the other side went into opening balance equity. We have a bill form that had accounts payable increased with a credit, right, because it's a liability, and then the other side went into legal. So this is an expense, which increased with a debit. And then down here, we've got our invoice, and what happened with the invoice. We could see that it was entered with an invoice form, which doesn't have debits and credits on it, but we can analyze the debits and credits with this report and say, okay, what happened? The accounts receivable went up. It's an asset. It went up with a debit balance because it's a debit balance account, an asset. And then the other side went to landscaping services, which is an income statement account. It's a credit balance account. And it went up by doing the same thing to it, which is a credit. And then pest control services, which is, again, a credit balance income account. Income accounts go up with a credit, so we increased it with a credit, and so on and so forth. So you can take a look at each of the forms and analyze what is happening from a debit and credit kind of scenario, remembering that if you're in bookkeeping or in the accounting department, debits and credits are what the mindset is typically going to be from an auditor's perspective, and possibly your tax preparer, depending on their background.